I remember the exact day I lost $300 in one afternoon. I was sitting right here, staring at my phone, watching the number just drop. And the worst part? I didn't even fully understand why. I just saw someone on YouTube making money, thought I could do the same, and jumped in with zero plan. That was my first lesson, and it was an expensive one. If you're watching this right now, before you put a single dollar into anything, I need you to hear what I wish someone had told me before I started.
8 years ago, I made almost every investing mistake in the book. I rushed in, picked the wrong things for the wrong reasons, and learned some expensive lessons along the way. So today, I want to walk you through exactly what I'd do differently, 4 clear steps I'd follow if I were building a portfolio from zero, right now. And by the end of this, you'll know how to sidestep the traps most beginners fall into, build real conviction as an investor, and actually set yourself up for long-term financial freedom. Let's get into it.
Step 1. Sort out your financial foundation first. Here's something that catches a lot of people off guard. Nearly 40% of adults couldn't cover a $400 emergency without borrowing. That's not a small number, and it's the exact reason so many people fail at investing before they've even properly started. Think about it this way. If something goes wrong, maybe your car breaks down, a pipe bursts, or life just throws a curveball, and you don't have money set aside, you'll be forced to sell your investments at the worst possible moment. Market dips and personal emergencies have a nasty habit of showing up at the same time. I've seen it happen. People get excited watching others with 6 or 7-figure portfolios on YouTube feel behind and start throwing every spare dollar into the market, including savings they can't really afford to lock away. Then the market drops, panic sets in, and they sell at a loss. They end up worse off than when they started. So before I touch an investment account, I do 3 things.
First, clear any high-interest debt. Credit cards, store cards, personal loans. If your debt carries 20 to 40% interest, and the stock market has historically returned 8 to 10% annually, you're leaking money faster than your investments can grow. Pay off the debt first. It's the higher guaranteed return. Second, build an emergency fund. 3 to 6 months of essential expenses, sitting in a high-yield savings account you can actually access quickly. I know it feels like you're delaying the real stuff, but this is what lets you stay calm and rational when markets get turbulent. Third, make sure your income and spending are predictable enough that you know exactly how much you can invest each month without it causing you stress. That stability is what lets you stay invested long enough to see real results. None of this is exciting, but think of it as level 1. Without it, the rest doesn't hold.
Step 2. Get clear on what you're actually investing for. According to an FCA survey of 10,000 investors, fewer than a third had any specific long-term goal in mind when they started investing. Most people just heard investing was a smart thing to do, opened an app, picked something, and hoped for the best. No clear destination, no real strategy. Then, when the market dips, and it always does, they panic and sell because they never had a reason to stay. If I was starting again, the first question I'd ask myself is, what is this money actually for? Early retirement, a house, financial independence in 20 years? Because the answer changes everything. The type of account you use, how much risk you take, and how you'll react when things get choppy. Here's a simple way to think about it. Short-term goals. Anything you'll need the money for in the next 5 years. Keep that in cash or a savings account. The stock market can be volatile in the short run, and you don't want to be forced to sell during a dip because you need the money.
Medium to long-term goals, 5 years or more away, invest that. The data's pretty clear on this. Between April 2020 and 2025, $2,666 invested in global shares grew to nearly $4,926.
The same amount in cash? Just $1,714. Over long enough time horizons, markets consistently outperform savings accounts. That's the whole point.
Step 3. Start small and stay consistent. Here's a number worth sitting with. Investing just $100 a month at an average annual return of 8 to 10% gives you over $140,000 after 30 years. You'd have only contributed $36,000 yourself. The rest? Compound growth, doing the work. Compounding is simple, but almost magical in practice. Your investments earn returns. Those returns earn returns. The snowball just keeps growing without you adding anything new. And yet, a Barclays survey found that 44% of people said a lack of knowledge was the biggest barrier to starting, and 41% said they were simply afraid of losing money. If that sounds familiar, I get it. The stock market seems technical and intimidating from the outside. But starting small removes the pressure. You're not risking much. You're learning by doing, and you're giving compounding time to work.
Step 4. Learn to stay calm when markets fall. The stock market has crashed 19 times in the last 150 years. Every single time, it has recovered and gone on to reach new highs. That should be reassuring. But when you're actually in a crash, watching your balance fall week after week, it doesn't feel like data. It feels like a mistake. There's a chart from Morningstar that maps over a century of market history. The Great Depression, the dot-com crash, the 2008 financial crisis, COVID. Some of those drops wiped out more than half the market's value. And every single one of them looks, in hindsight, like a blip on a very long upward line. The COVID crash, for example, took just 4 months to recover, the fastest on record. 2021's downturn took about 18 months. Even the Great Depression, the worst recorded crash in history, eventually gave way to decades of growth for investors who didn't sell. When I first started investing, I panicked every time the market dipped. I genuinely thought I'd made a terrible mistake. What I eventually learned is that patience is the strategy. Staying invested through the dips is how long-term wealth gets built. And this is why all the earlier steps matter. The emergency fund means you're not selling investments to cover expenses. The clear goals remind you why you're invested in the first place. All of it works together to keep you in the game when most people are heading for the exits.
If I was starting from scratch today, this is the exact sequence I'd follow. Get my financial foundation solid. Define what I'm investing for. Start small and be consistent. And train myself to stay calm when things get uncomfortable. Now that you understand exactly how to invest from scratch in 2026, the obvious next question is, where do you actually do this? And look, I'm not going to throw a random name at you and tell you to sign up. But I do want to mention Exness, because if you're a beginner looking for a platform that doesn't make the whole thing feel complicated and intimidating, it's worth knowing about. Exness gives you access to a wide range of markets, including stocks, indices, and commodities, with a clean, beginner-friendly interface that doesn't require you to have a finance degree to navigate. You can start with a small amount, which lines up perfectly with everything we talked about today. Start small, stay consistent, let compounding do the heavy lifting. The link is in the description. Take a look, explore the platform, see if it fits what you're building. You don't need a finance degree. You don't need a 6-figure salary. You just need a plan, some patience, and the discipline to not get in your own way. The mistakes I made early on didn't derail me because I stayed invested and kept learning. That's all you need to do too. And hey, if this video helped you even a little bit, do me a favor and hit that like button. It genuinely helps more people find this and start their journey the right way.
And if you want more videos like this, breaking down investing, trading, and building real wealth from scratch, make sure you're subscribed. I drop new videos every week, and I don't want you to miss what's coming next. I'll see you in the next one. Take care.